And Thibault, the question is money market fund, we talk about it, but what are they so successful today? You mentioned 1.7 trillion euros for the year fund. Is it a real alternative to bank deposit, and what explains the success of these funds?
Thank you, François. And hello, everyone. Very happy to be here to talk about this very trendy topic, the success of money market funds today. We will go into a bit more detail around the money market features, and one of the key features explaining why money market funds have been so attractive lately is the active management of the rate and of the credit duration of these portfolios. What you see here on the screen is the series of rate hikes delivered by the European Central Bank, represented by the yellow stair that is progressively climbing. And on the other side, the different colors represent the WAM of money market funds, which is the rate durations of these portfolios, their modified duration, the rate risk of these funds. You can see that most asset managers, and here it's just a representation of a barbell of money market funds within our range at BNP Paribas, we have significantly decreased the rate duration of these funds upfront of the rate hikes delivered by the central bank, resulting in very responsive funds in terms of performance in a raising rate cycle. Having a WAM of 1 day, which you see through almost the entire hike cycle, results in capturing all rate hikes overnight in your performance, whatever the extent and whatever the pace. So whether it is 25 or 75 basis points, you get it in your performance overnight. Whereas when you are taking some duration potentially on a term deposit or other securities, you take a rate risk, and over the whole rate hike cycle, the market has consistently underestimated the potential future rates. So you are always taking, let's say, a cost of opportunity by locking fixed rates on these periods. So that was one of the key strengths of money market fund. And this is achieved by investing directly on variable rate securities pegged on the euro short-term rate, for instance, on the Federal Reserve rate. The reason why money market funds are so responsive and correlated by the STR is this management of the rate duration. Having a WAM of 1 day will mean that your portfolio will remain extremely close to the STR, whatever the shifts in rate will become. But money market funds are also able to outperform this euro short-term rate. There has been also a change of paradigm in terms of short-term credit spreads offered by financial issuers. If I look back beginning of 2022, the financing conditions of financial issuers on 1-year maturities of high credit quality were about STR plus 5 basis points, which was extremely low. So if I take the picture, we had a euro short-term rate at minus 58, plus 5 basis points. Gross of fees, money market funds struggled to outperform their benchmarks. So that was minus 53, more or less. But with the repayment of the TLTRO3, so the very big loans granted to the banks, and this deterioration of the financing condition of the banks, we have seen a widening of their short-term credit spreads. They got back to the short-term commercial paper markets to seek for some liquidity. And that generated much more opportunities first for money market funds in terms of market deepness, but also from a yield perspective. Because instead of having STR plus 5 basis points, we today have close to STR plus 30 basis points. So we have 5 to 6 times more leeway today to add performance versus the euro short-term rate, while keeping a direct indexation to the euro short-term rate. Another component that protects the attractiveness of money market funds, even if we are today in a different cycle where we had a first rate cut announced last week, which will be effective in the market in tomorrow's euro short-term rate, is the inversion of the yield curve. Today, the shorter the investment, the higher the yield from the rate perspective. Say it differently, if you extend the duration of an investment, you get a penalty on the risk premium that is added normally in the total yield of the operation. So as of today, you need to wait about 1% of rate cut, so additionally 75 basis points of rate cut compared to what the central bank announced, to get a flattening of this rate curve. So before, money market funds has no more, let's say, premium versus the potential medium long-term rates. And that is also true on even short maturities up to 1 year. So this is one of the key components that today comforts us also in terms of potential outflows in money market funds. Investors are not extremely opportunistic in terms of yields because most investors of money market funds are also corporates bound to the cash and cash equivalent criteria, which will not go, of course, towards medium long-term assets. A key component, which we mentioned just earlier, is the regulation. That also contributed a lot to the attractiveness of money market funds. It was enforced, as a reminder, beginning of 2019 for existing funds, and it contributed to raise the awareness of investors on these products because the regulation set extremely clear guidelines for all portfolios to follow depending on their category, in terms of risks they are allowed to take, in terms of instruments that are available to these funds, and therefore in terms of potential volatility and return. This regulation, of course, we might see some evolution as mentioned just earlier, because regulation always needs adaptations to the different economic cycle and market events, but it was proven extremely resilient over the past 4 years, because we've lived a live stress test, as commented by the European Commission, with first the pandemic and the liquidity crisis. After that, we had a very significant geopolitical events actually, and we had a credit spread widening, and we had very significant rate hikes. In these market conditions, all money market funds in the marketplace behaved very well. We did not see potential defaults. Yes, some difficulties appeared, but money market funds have remained extremely resilient and provided liquidity around a yield extremely correlated with their benchmarks, which was the intent of the regulation at the inception. So that's contributed a lot to the success of money market funds. A lot of information there. Obviously, I'm not going to comment it all, but the ESG component has also been key. Most money market funds today integrate ESG principles. The European Union Green Deal has pushed different regulations towards corporates, asset managers, towards end clients, and it raised the awareness around ESG issues on the different potential investments and on issuers. And that resulted in an increasing demand for ESG products and even in money market funds. Today, many investors, actually in some regions, all of them, or almost all of them, require at least Article 8 money market funds, meaning money market funds integrating ESG principles, excluding some specific sectors, for instance, and even SRI-labeled products, socially responsible investment funds, applying an even more demanding ESG profile to the investments with, for instance, best-in-class approaches where you eliminate the laggards from each sectors, which we do at BNP Paribas Asset Management. And around these products, this is where we saw the biggest growth in assets under management throughout the industry. Article 8 money market funds, and particularly SRI-labeled funds. Within our own range, we have 2 of SRI-labeled funds, just to comment this. Over the past 4 years, these 2 funds doubled and respectively quadrupled in size. So that's more than the average market growth. So this is clearly where the growth of assets under management came from also. Now, for the complementarity with term deposits, money market funds are extremely successful. Term deposits have been also attractive for many different reasons. We always set money market funds as complementary to term deposits. It's not alternative, direct alternative solutions. Most of the shareholders we have at BNP Paribas Asset Management use both term deposits and money market funds, depending on their liquidity needs, depending on their investment horizon, and also depending on their investment policies. But here, if we focus on the key differences and the reasons why one investor should use one or another, the first and foremost, let's say, use of a money market fund is for its liquidity, because it will bring a yield that is highly correlated with the euro short-term rate, but you get no penalty when you redeem from a money market fund. Whereas on a term deposit, where you lock a maturity and a potential yield, you would deteriorate this yield by involving breakage fees. And this is where money market funds come clearly at hand when you are seeking for liquidity and have no or less visibility on your investment horizon. The active management of the rate and the credit duration, as we just mentioned earlier, are also extremely positive for money market funds. Lately, if you locked a one-year investment on a financial issuer, you got a yield close to 3.70%. But if the market is right, you would get the same result of an investment on fixed rates and on variable rates, and term deposits are mostly offered on fixed rates. But if the market is wrong at this point and underestimates the potential level of rates, so for instance, instead of having 3 rate cuts, but having only 1 rate cut, the result of this fixed rate you should have locked was not 3.70%, it was probably closer to 4%. So money market funds, thanks to the active asset allocation and the active management of these durations, help performing and benefiting from the different market events and cycles throughout the life of the investments. Absolutely. And the diversification, which is one of the key points of money market funds. Instead of, again, putting all your eggs in the same basket, money market funds invest in tens, hundreds of different issuers, mostly having hundreds of different securities, from a geographical perspective, also from a sector perspective. And this diversification is extremely difficult to replicate directly from the investor's standpoint. From this diversification perspective, you can achieve returns, which are very interesting, but also benefit from all the resources and all the advantages of these different sectors from a credit perspective. So investing in priority into the sectors which are either the most secured or into an improvement of credit quality. And this is where the asset managers, let's say, advantage comes at its most strong point, at its strongest point, sorry. Asset managers have teams of tens of research analysts who perform a credit assessment of the quality of all issuers on which money market funds are allowed to invest on. And this is required by the regulation. So that sets, let's say, a locker and a security into the potential investment universe of money market funds. This approach, which we highlight here as an example of what we do at BNP Paribas Asset Management, we have many different ratings provided internally, which are complementary to the external rating agencies. In some occasions, these are very different from the assessments of Standard & Poor's, Moody's, and Fitch. And this has proven its strength with this combination of 2 ratings, one of them being a solidity rating, representing mostly the solvency of the issuer with the EBITDA, net debt, turnover, etc., which are relevant for its sectors, and the issuer fundamental value, which provides a directional view of the credit improvement of deterioration of one issuer. And based on this matrix of credit quality, our risk department will allow us an amount and a maturity, and an authorization, of course, to invest on these issuers. This is how we make consistent the amount and the maturity of our investments with the credit quality of the issuers. And this is thanks to this model that, for instance, we've been able to avoid from Lehman Brothers to lately Credit Suisse. Because if one investor had an exposure to such credit institution in the event of a bankruptcy, of course, this poses a lot of problems, and this is clearly what we are trying to avoid in all money market funds, and this is the idea of the regulation, so behind that. Money market funds are extremely simple to trade, very easy, that can be done through electronic platforms, through Bloomberg, but also with classic telephone and email dealing. Here, this is just a visualization of the funds range at BNP Paribas Asset Management, but showing you the complementary here with term deposits. So you get on the left-hand side short-term money market funds, and on the right-hand side standard money market funds, which are a bit more flexible in terms of what type of duration they are allowed to take to generate some potential additional yields, but still offering daily liquidity and security. And here, from the left-hand side to the right-hand side, you could get a yield ranging from Ester flat on institutional share classes to Ester plus 20 basis points potentially. And this has been the past performances over the last quarter since the terminal rate. Of course, past performance is not a guide for future performance. But in this case, term deposits are complementary in the way that on very short maturities, you would get very competitive returns with money market funds, depending on the aggressive positioning of the credit institutions to capture these deposits. Term deposits can be more interesting on longer maturities, but in the end, it remains very interesting to keep the liquidity up to, on average, based on our observations of the market, up to 3 to 6 months. Above these maturities, if you have let's say a certitude on your cash needs, term deposits are on average more yielding, but that also depends on the economic cycle and how well the market swaps are priced for the euro short-term rates. Because as mentioned just earlier, it can be underestimated and would result in a cost of opportunity. So we always believe that both products should be used in an allocation of a corporate or an institutional investor.
Thanks a lot. So, but it just confirms that wallet sharing is quite important. We have core banks, so it's really difficult to stop investing in term deposit. And as you said, if we have visibility, providing we have visibility, a combination of both could be quite interesting in terms of performances. Coming back to a point, so we are convinced, we corporate, that it's really difficult to assess the counterparty risk because we are not specialists. We have some tools, but even if they are sophisticated, it's difficult to be as good as professional. Even for a bank, it's difficult to assess the credit risk. So imagine for corporates. So I keep thinking that you are professional of that, and you mentioned you have the tool, you have the team, you have the expert, you are in the market, so you are ahead of, in terms of information, ahead of us. So I think that you could be a good way, a sort of parameter or a way to test the market and to get the information. And so that could be useful, at least. It's something that we cannot, let's say, do and whatever and replicate. That whatever the resources and the tool we use. So, and we saw that a weekend could be sufficient to go bust for a bank. So it's difficult to react. Do you confirm that that's a key asset?
I fully agree, and this is one of the most competitive edge of money market funds.
Thanks a lot. So maybe a last point. So we've mentioned the reform, but do you also agree that at the end of the day, all this stress test live we faced are good proof that money market funds are rather resilient? So I guess that you are convinced that we don't need an additional reform.
Yes, I fully agree that money market funds resilience at this stage don't need an additional regulation to provide liquidity and safety to the investors. But as I mentioned just earlier, it's always important to adapt the regulation to the evolution of the market. So we will welcome the changes that will be positive in the end for the money market funds resilience, whether it is the use of liquidity management tools or enhanced liquidity buffers. But at this stage, even if the regulation sets minimum thresholds for liquidity at 7%, 7.5% overnight or 15% weekly liquidity for variable net asset value funds, on short-term money market funds, we have daily liquidity between 15 and 30 or even 40%, depending on the shareholders' concentration, the potential evolution of the liabilities, also the seasonality. Corporates, for instance, from April to July tend to pay dividends. And what happens in money market funds is that we receive outflows on the first quarter of the year, with corporates provisioning their potential dividend payments. And we already know in advance these potential outflows. So yes, money market funds could benefit from higher liquidity buckets, let's say, per se by the regulation. But in the end, asset managers already increase these liquidities in their portfolio, so we do not bound to what the regulation requires. We always try to go further.
And more conservative.
More conservative, absolutely.
No, Thanks a lot for this, Thibault. And again, so you will have in the room for the cocktail at -1, you will have a table with all our sponsors. So if you have technical questions about the performances, the family of funds they are all offering, and technical questions, do not hesitate to come and talk. So thanks a lot.
Thank you, François. Thank you all.